I need you to stop what you're doing. I need you to listen to what I'm about to tell you because this is not speculation. This has already happened. While you were celebrating New Year's Eve, while you were distracted, China activated the silver export ban. January 1st, 2026, midnight Beijing time, 70% of the world's refined silver supply just got cut off from Western markets. Not reduced, not limited. Cut off completely unless you're one of 44 government-approved companies. That's not even the real story. The real story is what the CME did 24 hours before China's ban went live. They raised margin requirements by 30%. Spot silver crashed from $84 per ounce to $72 in 48 hours. 17% drop. That's the largest two-day collapse since September 2020 COVID crash. Let me tell you what really happened here. This wasn't a market correction. This was a coordinated bailout. The bullion banks were about to default on physical delivery. Let me give you the numbers because numbers don't lie. Silver hit an intraday peak of $84.01 per ounce on December 29th. That's the highest price since 1980 when the Hunt brothers tried to corner the market. 45 years. We broke through a 45-year resistance level in December. The CME raised silver futures margin requirements from approximately $19,000 to $25,000. That's a $6,000 increase per contract, 30% jump overnight on December 29th. But here's what they don't want you to understand. Each silver futures contract represents 5,000 ounces. At $80 per ounce, that's $400,000 of notional value. Against a $25,000 margin, you're running 15-to-1 leverage, 15 times. That means a 5% price move wipes out your entire margin if you're wrong. Let me say that differently so it sinks in. The CME didn't raise margins to protect the market. They raised margins to force liquidation from retail longs before physical shortages exposed the fraud. Story number one. China exported 4,600 tons of refined silver between January and November 2025. That's over 148 million troy ounces flowing to Western vaults. Story number two. On December 30th, Chinese companies started offering $8 above spot price to buy physical silver, then $10 above spot by January 1st. Story number three, Shanghai physical silver traded at a 12% premium over London paper prices on January the 2nd. 12%. The spread has never been that wide. Let me connect the dots for you. China knew they were cutting off exports. Chinese industrial manufacturers panicked and started buying at any price to secure domestic supply. Do you know what a modern military needs? Silver? Do you know what solar panels need? Silver paste. Do you know what AI servers need? Silver contacts. China produces 15% of global mine supply, but they refine and process over 50% of total global silver. They're the gatekeeper to refined silver worldwide. The new licensing requirements demand companies demonstrate 80 tons minimum annual production capacity. They need proven export records from 2022 through 2024. They need $30 million credit lines. Only 44 companies qualified for the 2026 to 2027 export period. 44 out of hundreds of previous exporters. That's what we've been warning about for months. Resource nationalism weaponization. But here's the kicker nobody's talking about. The London Bullion Market Association vaults and COMEX registered inventories have been bleeding out since November. Physical silver withdrawals accelerated in December. By late December, estimates placed the paper-to-physical ratio at 356 to 1. That means for every 1 ounce of physical silver in registered vaults, there were paper claims on it. The margin hikes are a blunt instrument used to force paper traders out before they demand physical delivery. Think about this timing. CME raised margins December 29th. China's ban went live January 1st. That's 72 hours. You think that's coincidence? The CME knew the ban was coming and needed to kill the squeeze. We are watching the exact same playbook from the 2008 gold manipulation, the 2011 silver smash, and the 2020 paper crash repeated right in front of us. Here's what the mainstream media won't tell you. This is a bailout of bullion banks who are catastrophically short physical silver, not a bailout with taxpayer money. What happens to the price when the world realizes there's no physical silver available at $75? What happens when Western solar manufacturers can't source silver? Scenario 1, the COMEX price becomes irrelevant. We develop a two-tier market where Shanghai sets the physical price and New York trades worthless paper contracts with no delivery. Scenario 2, force majeure declarations. The exchanges declare force majeure, suspend physical delivery, and cash settle all contracts at artificially suppressed prices, while physical trades at triple digits elsewhere. Scenario 3, silver hits $125 per ounce by March 2026 as industrial panic buying overwhelms paper manipulation. Bank of America's silver forecast jumped to between 1 to 3. Some analysts are now projecting anywhere from $135 to $309 per ounce if supply chains completely break. That's not hype, that's mathematics. Here's what you need to understand about this two-tier market developing. Physical premiums in India jumped to $10 over spot during the first week of January. Physical silver in Shanghai trading 12% above London spot. That spread tells you everything. The paper price is fake. The physical price is what matters now. This is what they don't want you to know. When China restricted rare earth exports in 2010, prices increased 500 to 800% in 18 months. When China implemented gallium and germanium export controls in 2023, prices doubled in 6 months. Silver is bigger than both combined. This is the most strategic mineral restriction since OPEC. Timeline of collapse. Days, not weeks. Weeks, not months. Every major Western electronics manufacturer has approximately 60 to 90 days of silver inventory. After that, production stops. Tesla needs silver for every vehicle. Elon Musk literally tweeted on December 28th, "This is not good. Silver is needed in many industrial processes." Even Musk sees it. Apple needs silver for iPhones. Boeing needs silver for aviation electronics. Nvidia needs silver for AI chips. The entire Western technology ecosystem depends on Chinese refined silver. What not to do. Do not buy silver futures on margin. The CME will raise margins again, force you out, and you'll lose everything. Do not trust ETFs. The iShares. Silver Trust dropped 10% on December 30th. Paper silver is worthless if there's no physical backing. Do not wait for lower prices, thinking you'll catch the bottom. We are watching the exact same movie play out that we saw with oil in 1973, rare earths in 2010, and microchips in 2021. A strategic resource gets weaponized, prices initially drop from manipulation. Then, reality hits, and prices explode to levels nobody thought possible. We're in the manipulation phase right now. The forced liquidation from the margin hikes created a temporary buying window. But that window is closing. Physical dealers are already reporting premiums expanding to $15 to $20. You have a choice to make right now. You can be the person who ignored the warning signs, who thought $75 was too expensive, who waited for confirmation. Or you can be the person who understood what China's export ban really means, who recognized the CME margin hike as a desperate bailout, who secured physical silver now. When Western manufacturers start competing for the remaining physical supply, when premiums hit $50 over spot, when you can't find silver at any price, remember this moment. This is the archive. This is your early warning system. The great silver squeeze of 2026 isn't coming. It's here. Act accordingly or get left behind.